We're here to talk about savings primarily today. Have a little presentation to discuss that, what we do, what we can do, what your options are, maybe some strategies. And the only other thing that I would say is I am not a tax advisor. So we have various account types that we offer. People hear credit union, they think mom and pop. It's just savings, it's just checking, and that's it. We actually offer just about everything that all financial services companies do. The terminology varies from banks to credit unions, but from shares are the same things as savings, so I may use the words intermittently. But we have the basic savings, spending accounts, which are also called checking, money market accounts, which we talk about specifically, club accounts, certificates of deposit, IRA, retirement accounts, and health savings accounts. You don't need all of these. I mean, there's a lot of options. I mean, generally speaking, some people just want a checking account. Some people need all of them. It depends on what your needs are and what your goals are. But everybody's a little bit different. Generally, the first two accounts, the savings and spending accounts, I call life accounts, everyday living accounts. Going to the grocery store, going to get gas, buying stuff. From money market accounts, club accounts, share certificate accounts, the others, those are more life event type of accounts where you're saving longer term. They generally pay higher interest rates. Generally speaking, you are saving those for a goal, such as buying a house or a car or just some other type of slightly longer term event rather than just going to the grocery store every day. Basic savings accounts, by definition, is a simple bank account that earns interest. It sounds stupidly simple, but a lot of people don't know what it is. You as a depositor will give us your money, we will hold it for you, we will pay you something to hold it for you, and you'll have access to it pretty much whenever you want it, by various means, whether it's taking cash out at an ATM, using your debit card, or just going to the teller line and taking out your cash. It's very simple, daily account oriented. It's a lot safer than putting it in your mattress. The difference between doing that and leaving it with us is that we will pay you. On the screen you see a graph which discusses the compounding interest theory. Roger Crandall discusses it ad nauseum at times when he does a lot of his Roger talks. Compounding of interest is free money to everybody that saves money. The theory is basically, if the money sits in your cookie jar and you put $20 in there, you have $20 in a month, you have $20 in 2 years, you have $20 in a decade. If you put your money in an account and it pays interest, what happens by compounding is we will pay interest on that money, so $20 will become 21, being a little exaggerative in the interest rate, but as you earn more money, we'll pay interest on not only the $20, we'll pay interest on the money that you've earned on top of it. So when it was 21, we pay interest on 21. When it becomes 22, we pay interest on 22. So it grows, and it grows more rapidly than just a straight line. That is really lost on a lot of people, the compounding theory. It is a way to accelerate savings. Obviously, the more interest that we pay, the more it accelerates, which is why the money market type of accounts are really goal-oriented, and you can accumulate wealth and interest much more quickly. It is the primary and most basic function of any bank or savings institution for people that deposit money. Spending accounts, and those again refer back to the life accounts. In this case, it's checking specifically. We call them spending accounts, but it really is just a core checking account. We have three types of checking accounts. I referenced two here very specifically. The basic checking is exactly what it sounds like. You have checks, you have a debit card, it's free. We do not pay interest, but you also don't have to pay any fees or very minimal fees. If you overdraft or that sort of thing, there's a fee involved. But if you maintain at least a $0 balance, it's free to use, and it's the most basic way to go. We have what's called a rewards checking, which is called Kasasa. It's something new that we started this year. It's rewards based, and it sounds like it's a strings attached account. There's very little strings attached. It's really a usage account. If you swipe your debit card 12 times or more a month, and then you maintain e-statements and you access home banking at least once a month, we will pay you an exceptionally high interest rate, which right now is 2.5%. There's a cap of $10,000 in the account, so people can't just park thousands and thousands of dollars, but it's really a way to fund your daily regular spending and get a much better reward. The other option that we have is called a cash back. So we either have a high interest or a cash back, and you can get up to $6 a month in rebates and refunds if you spend at least $300 a month in your debit swipes. And it's roughly 2/3 of our members take the cashback option over the high interest rate, and that seems kind of normal. We discussed it with the vendor that services this for us, and they see this across the country as a very typical usage and popularity. It's just the way that people are now. Everything's about rewards. Everybody loves rewards. So the other one that I don't reference on this page is a money market checking account, and that's really a higher balance, higher yield also. It doesn't pay as good as the Casasa Rewards account, but it's more for parking long-term money. You don't have to think about it. There's no withdrawal limits, there's no anything. It just pays a little bit better rate. Money market funds. This is more of a long-term, it's like the savings account, except there's a minimum balance of $2,000. If you maintain more than $2,000, we will pay a rate anywhere from 1.25 to 185, depending on the tier that you're in. There are no withdrawal limitations as far as you have to use X number of withdrawals like the rewards accounts. On these particular accounts, they are higher yielding. They are more of a long-term, goal-driven, compounding interest savings account. The misnomer with the money market is that it is a stock market account. It is not. It is just a high yield savings. Money market is used interchangeably between stock funds or money market mutual funds and then this particular type of account, because they work similar, but one is really a brokerage house account versus an in-house credit union or banking savings account. Very good method to save extra money, and especially if it's money that you don't want to touch and you want to just park it and forget it. You have access to it, unlike a certificate, which is locked in. Certificate has a specific start and end date for maturity. The money market is still liquid, and it is something that you can access your money, with just about any time you want, and get a better yield, a rate of return for it. Club accounts are a little bit different. I would call these a 1960s account, but they're still popular with a lot of people, and it's because it's a defined goal savings account. It's liquid money. You can have it anytime you want, but generally speaking, people will take $20 a paycheck or $50 a paycheck, and they'll put it aside. Christmas club accounts are usually paid out on the 1st of November, and you save for 12 months, and then you get all the money and you go Christmas shopping with it. It's just like what it sounds like. It's a Christmas club. Vacation clubs are something that were popular here a long time ago too, and we still maintain a lot of them, but they're very goal driven. People, same theory. You save money all year long. The money comes due May 1st. I'm sorry, and you get that lump sum, and it's your vacation fund. It's kind of a way to set it and forget it savings. You cannot access it from home banking. You cannot take it with your debit card or your credit card. So we restrict the use of it because, generally speaking, people are putting the money there for the goal at the end. So if you can take it along the way, you've got nothing at the goal date. So you can still go to the teller line and get the money if you need it. So if an emergency comes up or whatever, but it's just a way to force yourself to save some money. Certificates are start and finish maturity driven. They tend we pay a much higher rate on those in general. You open up a certificate in January, and you can pick anywhere from 3 months through 5 years of maturity date, and it will compound interest and pay over that life of that loan, whatever you pick for that term. $500 minimum on the balance on the startup on those, but you can put as much as you want in there. We have a jumbo. If you have $100,000 lying around and you want to put that or more in there, we'll pay you a little bit more for that money as well. The reason that we pay more on that is quite simply because the money's locked in. If you decide to break a CD before its maturity date, it is subject to penalty. We tend to waive those in an emergency situation, or waive the penalties, but generally speaking, it's locked in, and because we know we have that money for a fixed period of time, we'll pay you much more for it. And those are generally goal-driven accounts as well, buying a home or a car or what have you. Retirement accounts, and they work just like the regular savings accounts. There's certificates of deposit that pay a better rate. And then there's kind of the holdover overnight accounts. They are good mechanisms if you don't have an employer-driven retirement savings plan like MassMutual does. And again, we do hold them, we do offer them. I would treat a credit union account like a supplemental IRA that you wanted to put even more away than what you're allowed to with your employer. And they do work, and we do service quite a few of them. The younger you are, the better you are off with that stuff. Max out as much as you can now. I mean, compounding is just such a great thing, but at least take the company match at 5% because it's free money. Nothing's free, but this is as free as it gets. But if they're going to give that to you, take it. If you want to do more than that, great. I do know of many people who maxed out in their early 20s, and by the time they're 50 years old, they have enough to retire on. They almost don't even have to put any more money away if they don't want to. They do, but they don't have to. But it's great to get it over with and get it over with sooner the better for various reasons. Most retirement accounts, and this is where the whole tax advisor piece comes in, most retirement accounts can be liquidated early for emergency situations. So even though that money is locked away in a quote-unquote retirement account, if you need access to it, there are instances where you can get it. I do know of a couple of instances where for a home purchase, if it's money for a down payment, they will allow you to take it. Emergency situations such as health issues and so forth, they'll allow early withdrawals. It's just something to be aware of. But it's even though it's locked up, there are ways to access it if you really, really need it. So just something to be aware of. There are a couple of retirement account types besides the 401k and the pension. They're more the traditional. They're called just simple IRAs, a Roth IRA, an education IRA, which those almost are never used anymore because of other methods, the 403b accounts, and then just the simple IRA accounts. All are subject to tax at some point. The Roth and our pre-tax IRA deposits. So if you earn $1,000, you put the whole $1,000 in, you don't get taxed on it. It's a tax deductible item because you'll pay it later, but you won't pay it now. There's no right and wrong method. That's where a real advisor comes in to use that. But it is a good way to have some tax-free, at least current tax-free savings. Health savings accounts, again, became popular and introduced, say 6 or 7 years ago now, maybe 8 years ago. They are setting aside funds for your deductibles. Health savings accounts were set aside as a tax-free way of putting your deductible money away. So if you have a $5,000 deductible, you use this account to chunk it away. Every paycheck puts some money away. And we do pay an okay rate of return on it. It is there. It's only supposed to be used for health premium payments, prescriptions, doctor visits, etc. But instead of having to just live day by day and have a big bill come up, you can have this account set aside. The last part of it really is kind of about the strategies and the way to best utilize us and best utilize your bank. Defining needs is probably the hardest part because that really is, in layman's terms, a budget. You have a budget set aside for yourself, what you need for your gas, what you need for electricity, what you need for your rent or your mortgage payment, and what you need to really truly live on. And then you have money that's left over. Do you have something that you have down the road that you're saving for, like a car or a mortgage or a computer or anything? That would be setting a goal. Very simply put, it's you know how much you need, you know when you need it, you got to figure out how to get there. I've already said it without saying it, making a plan. If you need something in 12 months, you gotta come up with you have that goal set, come up with a plan to how you're gonna reach it and save for it. We do have restricted access accounts such as the clubs, which you can't get to at home banking. You can see it, but you can't move your money from it. So it's kind of your own little stopgap to keep you from accessing the money if you really don't want to take it. It's really the way to go. And then the last part, Captain Obvious, is stick with your plan. I mean, if you really have something that you want to buy and that you need, you got to just be diligent and stick to it. It's not easy sometimes. It's easy for your friends to say, hey, let's go out and go have fun, and you want to take that money that you saved and do it, but there's a price at the end of it that you don't get what you want. It's really a very simple, no kidding type of a plan, but sometimes people just need to hear it. You can make it very easy for yourself as long as you just keep it simple, keep it in small pieces, and just have a map for yourself. We can do a lot to help you with that, whether it's advice, one-on-one advice. There's no right answer for everybody. There's no magic bullet. There's a number of savings mechanisms that I went through today that we can use and set up to work in your best interest and maybe maximize your savings. But there's definitely different ways of doing it. And we do have people that talk to people every day. We hear your problems, we hear your concerns, we hear your goals and your aspirations, and we can help you set stuff up. It can be really rewarding at the end to buy something that you've saved for. If you have any other questions, you can come down to the credit union. I mean, somebody's always around if you have an idea or a thought or something you just want to do and want help setting up,